72-hour blackout nobody expected. Asia pays $195 for silver, COMEX silent. For 72 hours, the world's most trusted silver price simply stopped speaking. No alerts, no updates, no answers. While New York slept, while Western markets went dark. Buyers in Asia quietly paid $195 for the same ounce of silver still officially priced far lower. That gap should not exist. It cannot exist. And yet, it does. Because this is not volatility. This is not speculation. This is a system being tested while its guardians are offline. When price discovery breaks, when physical demand ignores paper rules, someone always pays the price. The only question is, who will be holding the losses when the silence ends? Welcome to Boring Currency Registry. This channel is built for those who have seen cycles repeat, promises fail, and systems reveal their limits over time. If you believe understanding matters more than excitement, consider subscribing, not for noise, but for clarity. And tell us something before we continue. From where in the world are you watching this moment unfold? At exactly 3 in the morning, Eastern Time, on Sunday, January 18th, 2026, the global silver market entered a condition it was never designed to handle. In New York, the official price of silver sat frozen at just over $73 per ounce. Screens showed no movement, no reaction. The system was closed for a long holiday weekend. At the same time, markets on the other side of the world were fully active. In Shanghai, traders approved transactions near $195 per ounce for physical silver. Tokyo and Singapore showed similarly elevated prices. These were not estimates or forecasts. They were completed trades on regulated exchanges involving immediate delivery. The difference between the Western reference price and the Asian physical price exceeded $100. In a globally connected market, such a gap should be corrected almost instantly. Arbitrage mechanisms are meant to close it. Information flows are meant to prevent it. Yet during this window, those protections were absent. This period became known as the 72-hour blackout. The blackout was not caused by crisis or malfunction. It was caused by timing. A U.S. federal holiday closed banks and futures markets. From late Friday until early Tuesday, the Western system responsible for global price benchmarks was silent. Under normal conditions, this pause would be uneventful. Markets close and reopen regularly, prices adjust, and activity resumes. But this time, the silence revealed a deeper weakness. Asian markets did not stop. They continued trading, settling, and delivering physical silver. Price discovery did not pause. It simply shifted location. The price rose not because of panic, but because demand required it. Buyers in Asia were not purchasing contracts. They were securing metal. The price reflected scarcity and immediacy. In contrast, the Western price reflected inactivity. It appeared stable, but only because it could not move. For those watching closely, the danger was clear. A benchmark that cannot respond while real transactions continue elsewhere loses credibility. Once credibility is questioned, confidence begins to erode. The blackout exposed how dependent global markets are on continuous participation. When one side steps away, the system does not wait. It adapts. By the time Western markets prepared to reopen, price discovery had already taken place. The market had moved without them. And when silence finally ended, it would not be a return to normal. It would be a confrontation with a new reality already established. While most observers focused on the shocking price gap, experienced analysts looked deeper. They understood that prices do not fail on their own. Systems fail first. What unfolded during the blackout was not a sudden event, but the exposure of a structure that had been quietly weakening for years. The Western silver market is built on paper. Futures contracts, options, and derivatives dominate daily trading volume. These instruments are designed to provide liquidity and price stability. In normal conditions, they work, but they rely on one assumption above all others, that very few participants will ever demand physical delivery. That assumption was no longer holding. At the center of the Western system is a simple distinction that most investors never examine. There is registered silver and there is eligible silver. Registered silver is available for delivery against futures contracts. Eligible silver is stored in approved vaults but owned by private parties. It is not for sale unless the owner chooses to sell. During the blackout, registered silver inventories were near historic lows. The amount of metal available for immediate delivery was a small fraction of the paper claims outstanding. For every real ounce in registered vaults, there were dozens of paper promises tied to it. Under normal circumstances, this imbalance stays hidden. Most contracts are rolled over or settled in cash. Delivery is rare. But when buyers begin to question paper settlement, leverage becomes a liability instead of an advantage. The leverage embedded in the system magnifies risk. Large financial institutions hold concentrated short positions, meaning they have promised to deliver silver at lower prices in the future. These positions are manageable only if prices remain stable and delivery requests remain limited. During the blackout, neither condition was guaranteed. As Asian markets pushed prices higher through physical demand, the Western paper market could not respond. Margin requirements could not adjust. Short positions could not be reduced. Risk management systems were effectively paused while exposure continued to grow. This created a one-sided situation. Losses were accumulating in theory, but no action could be taken in practice. For institutions built on constant adjustment and hedging, this was a dangerous position to be in. What made the situation more fragile was concentration. A small number of banks controlled the majority of short exposure. This meant risk was not evenly distributed. If prices moved sharply upon reopening, losses would not be shared across the system. They would be focused. In such environments, confidence matters as much as capital. When counterparties begin to doubt whether delivery can be honored, behavior changes quickly. Contracts are no longer treated as interchangeable. Physical metal becomes preferred over promises. This shift does not require panic. It only requires calculation. Asian buyers understood that paper prices were frozen, not authoritative. They understood that physical metal, once acquired, could not be printed or delayed. Paying a premium was not irrational. It was insurance. Meanwhile, Western market participants faced a different reality. Their exposure was priced on screens that were no longer connected to global demand. The longer the blackout lasted, the greater the disconnect became. From a strategic perspective, this was not a silver story alone. It was a lesson in market design. Systems optimized for efficiency during calm periods often perform poorly during stress. When flexibility disappears, leverage amplifies outcomes. By the end of the blackout's second day, the structure beneath the price was under strain. Nothing had officially broken yet, but the conditions for disorder were in place. When the market reopened, it would not be deciding where silver should trade. That decision had already been made elsewhere. The reopening would only determine who would absorb the cost of catching up. And in markets built on leverage and confidence, catching up is rarely smooth. By the third day of the blackout, the question was no longer whether silver prices were rising. The more important question was who now had the authority to define those prices. In modern markets, authority does not come from tradition or reputation. It comes from who controls settlement, supply, and continuity. During this period, that authority had clearly shifted east. Asian markets did not raise prices to make a statement. They raised prices because transactions required it. Buyers were not bidding on expectations or forecasts. They were securing physical silver for immediate use, storage, or strategic reserve. The price reflected urgency rather than sentiment. This distinction mattered. In the Western system, most trading volume existed in contracts that never resulted in delivery. In Asia, the market structure emphasized physical settlement. When buyers committed capital, they expected metal, not cash substitution. Because Asian exchanges remained open, they continued to perform the most basic function of any market, matching supply with demand. When supply tightened, prices adjusted upward. There was no pause button. This continuity gave Asian prices credibility. They were not theoretical, they were executable. As long as metal was changing hands, those prices represented reality for anyone who needed silver, not exposure. Western benchmarks, by contrast, were static. They were waiting for markets to reopen before reacting. But waiting has a cost. In that time, contracts were signed, inventories were allocated, and supply was removed from the global pool. Large industrial buyers understood this dynamic well. For them, silver was not an investment. It was an input. Delays carried operational risk. Production schedules, delivery commitments, and revenue forecasts depended on reliable supply. Paying a premium was preferable to facing shortages. This is where the shift became irreversible. Once industrial buyers accepted higher prices for certainty, the market's center of gravity moved. Price was no longer anchored to a Western reference. It was anchored to where metal was actually available. Central banks also played a role. Several had been quietly increasing silver reserves through direct agreements with producers. These purchases did not touch Western exchanges. They bypassed them entirely. The message was subtle but clear. Physical security mattered more than paper efficiency. For entrepreneurs and business leaders, the lesson was structural. Price authority follows settlement. When the entity setting the benchmark cannot deliver, it eventually loses relevance. The market does not wait for permission to reprice. As the blackout continued, Asian prices did not retreat. They stabilized at elevated levels, suggesting acceptance rather than excess. This signaled that buyers were comfortable with the new range, at least for now. By the time Western markets prepared to reopen, the environment had changed. The reference price they had once dictated was now being referenced against them. They were no longer leading the market. They were reacting to it. This role reversal carries consequences. Reactive systems tend to absorb shocks rather than distribute them. Adjustments happen suddenly, not gradually. The blackout revealed that global markets are not truly global at all times. They are only as unified as their weakest link. When one system pauses, another can take control. And once control shifts, it is rarely handed back without cost. As the blackout neared its end, attention shifted back to the Western markets preparing to reopen. The silence had lasted 72 hours, but the consequences of that pause had been quietly compounding. When trading resumed, the system would not be restarting from where it stopped. It would be reopening into a market that had already moved on. The first challenge, facing Western institutions, was adjustment. Prices frozen for days must eventually reconcile with reality. If the official price remained far below the levels established in Asia, arbitrage pressure would become immediate. Traders would demand delivery at the lower price and resell into higher-priced physical markets. This dynamic leaves little room for delay. At the same time, short positions built under the assumption of stable prices would come under stress. Rising prices increase margin requirements. Institutions using leverage would be required to post additional capital quickly. If they could not, positions would be closed automatically. Forced buying would follow, pushing prices higher and increasing pressure on others. This feedback loop is well understood in theory. In practice, it unfolds rapidly. What begins as a pricing adjustment can turn into a liquidity event. The speed of modern markets allows little time for orderly response. Industrial demand adds another layer of complexity. Unlike financial players, manufacturers cannot simply exit the market. They require silver to operate. If supply is uncertain, they must secure it wherever it is available. This creates a floor under prices. Even as financial positions unwind, industrial buyers continue to absorb metal. Exchange operators face difficult decisions in such environments. They can allow prices to rise freely and risk exposing structural weaknesses, or they can intervene. Interventions may include trading halts, settlement changes, or emergency rule adjustments. Each option carries costs. Confidence, once questioned, is difficult to restore. For business leaders and entrepreneurs, the outcome matters beyond silver. This event illustrates how interconnected systems respond to stress. Dependence on benchmarks, assumptions about liquidity, and trust in intermediaries all come into question at once. Markets function on confidence as much as capital. When participants believe rules will hold, they behave predictably. When they doubt delivery, settlement, or fairness, behavior changes. Capital seeks certainty. As Western markets reopened, the key issue was not volatility, it was credibility. Could the system absorb the repricing without signaling failure? Could it reconcile paper obligations with physical constraints? Regardless of the exact path taken, one conclusion was unavoidable. Prices formed during the blackout could not be ignored. They represented real transactions, real demand, and real scarcity. The silence had not paused the market, it had relocated it. For those watching carefully, the lesson was clear. Risk does not disappear when markets close, it accumulates. Systems designed for efficiency must also be designed for interruption. When they are not, pauses become pressure points. The 72-hour blackout would be remembered not for how long it lasted, but for what it revealed. In moments of silence, structure speaks. And when the silence ends, the adjustment is rarely gentle. For decision makers, the question moving forward was simple but critical. Was their strategy built for continuity or for assumptions that no longer held?